Now, with this view on the Fed and the central bank's market impact, Steve Eisman, senior portfolio manager at Neuberger Berman. And we've had you on enough that I'm always a little bit hesitant to try to ask you for big picture, top-down analysis, because a lot of times you don't really want to go there.
I actually have an opinion on this one.
Good. You have an opinion on this, but I'll just start by saying we're in kind of an interesting environment where we're definitely worried that the economy, for Fed reasons and for Fed cut reasons, we're worried that the economy is staying strong and that inflation.
I think it's more than staying strong. It's actually, I think there's been a reacceleration.
But we're also worried that there's going to be a recession because the Fed is going to have to engender one to tame it. So we're worried about the economy's too strong and there might be a recession. So
everybody's hoping for a little bear's porridge.
Exactly. Right. Something just right. Because we're worried. And has that ever happened? Can we really orchestrate that?
Yeah, we have it right now. Everybody should just relax.
So is that your view right now?
My view is I feel that ever since Greenspan was in charge of the Fed has always been extremely insensitive to its own impact on markets. And, you know, when Powell said, I think it was last week, it feels like an eternity ago, that financial conditions are tight, I was like, what planet are you on? So, I mean, my view is the economy's fine. There should be, I personally think there should be no Fed cuts this year. And, you know, the market will do whatever the market does, but the economy's fine. And why would you cut? You know, my actual fear is that if the Fed were actually to cut rates, the market goes into it becomes, I guess, bubblicious, and then we have a real problem. So, you know, things are good. The Fed should do nothing and wait for data to get weak because there's no weak data.
We still argue about, do you look at rates in absolute terms or do you look at them as,
you know, that debate bores me.
But in absolute terms,
really
they're not. In absolute terms, they don't seem high. But they're up 500 basis points.
So and has anything bad happened? Nothing bad.
No, that's
happened.
What I mean. I remember 7 and 8%, and businesses did just fine.
So the economy is good. I actually think, like I said, it's reaccelerated somewhat. Why would you? On what basis would you cut rates?
Some people think that the shock of 500 basis points is dislocated. Then
yeah, well, they've been talking about that shock for the last 2 years, and the economy stays fine.
So what's causing the Fed to talk about 6 rate cuts 6 months ago?
My personal opinion is I think Powell is deep down is just a dove. He's always been a dove. Raising rates was out of character for him. He had to do it, and he wants to cut rates. But at this point, you know, not that anybody ever calls me, but you know, I would just do nothing. Why would you do something when the economy is fine?
You don't think we need to raise?
No, I don't. But actually, my fear is that if they cut, then eventually we'll actually have to raise. That would be the worst possible thing that could possibly happen. So, you know, one of the things I've learned as a portfolio manager is maybe the hardest thing to do as a PM is to do nothing, because it's so easy to actually do something. And it's the same thing with the Fed. It's so easy to do something. They could cut whenever they want to cut. The hardest thing to do is just to sit back and say, okay, everything's fine. Let's just sit and wait. And if things get a little weak, then we can cut.
You don't think there's, you said bubblicious. Are we pre-bubblicious yet? I mean, we're getting it.
I mean, look, the market, but the fundamentals are really good. You know, one thing I always think about is, you know, 1999, 2000, when the market definitely was in a bubble. But what killed the bubble was not that it was a bubble. What killed the bubble was that the Fed raised rates a lot and put the economy into recession. It was the recession that killed the bubble, not that it was just
so what do you think is driving this economy, though? Is it new productivity gains that somehow AI is coming?
I think the two big things that are happening right now. No, I don't think it's the liquidity per se. I think it's real fundamental is that there's real AI, there's real investing, and there's tremendous amount of money being spent on infrastructure. And there's still a shortage of jobs, so the consumer is fine. It's a nice, you know, it is you know, little bear's porridge in a way. So why would you spoil it by raising rates, by lowering rates?
But just going back to like 2000, like the idea of a bubblicious situation at that point. You said it was the Fed raising rates that made it. I mean, the Fed raised rates and then made business models where you were making no profits.
Right, but today, the companies that people talk about are real companies that have real revenue. that have real earnings. I mean, look,
Agreed,
NVIDIA's earnings
but
have
I'm just saying
tripled.
that it wasn't necessarily the Fed just raising rates. The Fed raised rates, and then it was.
No, but then the economy actually went into recession, and the
actually
speculation went out of the
Can I
market.
ask a question that may seem political? We are in an election year.
Yes.
And depending on the political channel you watch, you might be told that the economy is terrible and that folks are spending, inflation is run away,
right.
Costs of everything are up, everything is, the sky's falling.
Right.
And then I'm hearing you, as someone who's in the markets, say the economy is great and that this is actually like a Goldilocks
Please
moment.
don't say that word Goldilocks. It's very sensitive.
Whatever you want to call it.
Little bear.
Larry Kudlow used to talk about that. He used to drive me nuts.
Whatever you think this sort of moment is, and I'm hoping that you can square the circle, if you will, of how these two ideas could exist, unless you just believe that one.
Say the Biden economy is great and it's not getting credit. Is really where we head with many guests.
But it's fair. It doesn't get credit. I mean, look, the unemployment is really low. Wages are still going up.
Wages are just finally going up.
Right, for the last few years.
They're below, people's spendable income is still below where it was when he took office.
That's fair, but the trend is up.
It has been,
and people still have savings. The only thing negative you could say is that there's been inflation, so some things are harder to buy and harder to buy.
But, a little bit, 30%.
But okay, that's fair. But inflation is starting to come down, or at least it's flattened out.
The rate of increase is coming down.
Right. Okay, but wages are still going up. All I can tell you is that
otherwise you're calling for deflation, which would be worse.
I'm not calling for it.
No, I'm saying, but
no, nobody wants that. But
the
the price increases are in, and for everything.
That's fair. But the only thing I would just say is that there's no sign that the economy is weakening.
Right.
There are signs that the economy is getting a little.
But if
stronger.
you're living on, if you're not lucky and you're not like us, you go to the grocery store and you're buying less than you did 3 years ago.
Okay, maybe. But still, things are still pretty good overall.
For us, things are pretty good.
No, for most of the people in the country, things are pretty good.
Why would it be good for most of the people in the country if they can buy less than it was 3 years ago?
Well, it depends on what you're talking about. Wages are still going up. People are employed. There's a shortage
they're finally going up, but they're not back to where they were in real dollars 3 years ago.
Okay, so you can't have everything.
Our next guest says, well, it wasn't a good quarter. I want to get to Dan Ives and everything he's got to say. Of course, longtime bull on the stock from Wedbush Securities, Managing Director of Equity Research. Dan, I'm reading your report, which you wrote very quickly. Let's call it as it is. While we were anticipating a bad quarter, this was an unmitigated disaster. First quarter deliveries was a nightmare quarter for Tesla, you wrote. Elon is now pressured by the street, and China demand remains very soft. And you also say, in this case, street criticism is warranted. But then I end, and you still have an outperform rating, and I wonder why.
Hey, look, I mean, for the long term, like in terms of the actual opportunity for EV, for full self-driving, for autonomous, that's still there. But let's just call it like it is. This is no smoke and mirror. I mean, if you looked up train wreck in the dictionary, you'd see a picture of Tesla's 1Q quarter. And, I think the big problem is deliveries. How do you reverse the trend? And that's why I believe this is a fork in the road. In other words, Musk either turns this around, whether it's cutting prices, put the strategy in place, or David, I think we sit here maybe 3-4 quarters from now, and this was actually a seminal moment and the start of what could be some darker days ahead if they do not turn this around.
All right, but what does the turnaround look like? You say cutting prices. Clearly, they're facing more competition from Chinese EV makers, not just in the domestic Chinese market. So what do you do if you're Tesla?
I think you have to lay out the strategy. Okay, what are price cuts going to look like? When are the new models coming? What could software be as a percent of revenue? What's the AI roadmap? Right now, it's essentially playing darts blindfolded. You don't really have an adult in the room. The conference calls, as we've talked about here, have really been horror shows. So investors, they're hoping in terms of that, what's on the other side of this. Now, in terms of the growth, the opportunity, $30 billion in cash, they're in a phenomenal position from that perspective. But I'd say probably this is what I'd say in the last 5 years, probably the darkest period relative to what we're seeing in China. And this quarter, exclamation mark.
All right, but you talk about, the hope of investors. You still clearly have hope as well. So what do you base your hope on? You've been, I mean, the last 2 minutes here, you've been quite negative.
It's that we're 3-4% of automobiles are EVs. Is that full self-driving autonomous? You could argue that could be $1 trillion worth of value from a software perspective. The China story, you've seen the price cuts start to stabilize. They had a good week of the last quarter. So there are some optimism, and I still believe you could be toward 2 million units for the year. But this quarter, there's just no way to sort of glass half full it. I mean, this is one where even whisper numbers call it 415K. 386, a disaster.
So is it supply or demand? Because we expected some production setbacks in the first quarter.
Look, I think supply would be dog ate the homework. Maybe call it 30K. You could explain that in a press release. But realistically, it's demand. And I think the problem here, Sarah, is that, okay, you're either going to cut prices or ultimately, like, you're going to hold serve and then focus on what you could actually do, but hold margins and where volumes could go. The problem is that you can't just put one toe in the water. In other words, like, what's the strategy? How are you going to reverse?
And do you know
these are not good, David. That's why the stock is down. Deliveries in the first quarter of 387,000 vehicles. Let me put that into some perspective. The FactSet consensus as of Friday, and it had been coming down, was for 457,000 vehicles to be delivered. First quarter of last year, the company delivered 422,000. So this is a year-over-year decline, the first since 2020 that we've seen from Tesla. And in terms of production, the company produced 433,000 vehicles. They do point out the fact that they had the change in the ramp-up in production in Fremont as they come up with the new Model 3 Highland edition. They also had the Red Sea issue, also the issue with production at the Gigafactory in Berlin. Not said by the company, but clearly one of the main factors, guys, what's happening in China. And we know what's happening there as they have lowered their production, and we've seen the announcements or the reports come out of China, and that clearly has an impact here. That's why the stock is under the pressure that you're seeing right now. Again, 387,000 vehicles delivered in the first quarter. The street was expecting 457. Even some of the bearish analysts were expecting, 410, 415, not 387. Guys, I'll send it back to you.
Quick.
Sorry.
No, I was going to say, Phil, full year estimates, I guess we can say goodbye to some two handles, right?
Oh, I think that's a given. I think that's a given. Most were already bringing them under 2. We had a few people saying 1.91 million deliveries for the year as the estimate that they were putting out there. For some perspective, and I don't know if we can pull up the chart that we have showing annual deliveries, they delivered 1.81 million vehicles last year. And if they were to go to 1.92, 1.93, that would be about an 8% increase in deliveries. Now the question becomes, do they hit 1.81 million? Is there a possibility that they don't even make that? That possibility is out there, but it's early, and a lot of things can change. Obviously, production is likely to come back much stronger, and deliveries should improve in Europe. They've been clearing out a lot of inventory in the first quarter, and if things start to firm up a bit, then certainly we expect higher numbers in the second, third, and fourth quarter. To what extent remains to be seen. China's the wild card in all of this, guys. They are brutally competitive in terms of what's happening with EVs and EV pricing, and that's having an impact. There's no doubt that that's having an impact on Tesla. And remember, Shanghai is not just where they supply China, but that's also where they supply other markets around the world. So they can offset some of, the impact of just pure China and the competition there in terms of vehicles being shipped to other markets out of the Gigafactory in Shanghai. But there's no doubt that this competition in China has had an impact.
Now, Phil, I know that the United States is not at the fulcrum. It is China, and I know the problems in Berlin. But there's this kind of this newfound, we don't want to go electric. We want ICE. We also are willing to have hybrid in this country. It has
we want hybrids.
Yeah.
Americans are embracing hybrids right now.
But it's not what. If you're someone who wants us to electrify and get off of nuclear, get off of go to nuclear and get off of coal and get off of nat gas, it's not going to come together at that level.
No, but that's not how consumers think, Jim. I think there's very few people in this world who sit there and think, well, ultimately, is the fuel source for this a coal-burning power plant? Is it nuclear? Is it hydropower? That's not how consumers think. You know that. The way consumer thinks is, what's the best option for me price-wise? And then also, am I comfortable making this transition? And there is no doubt that the recharging issues in this country are a huge issue. The first adopters, they could live with it. Not the people who are now looking at buying a vehicle now. And I hear this time and again from my friends who are considering buying an electric car. Almost all of them say the same thing. If I'm in Chicago and I've got to drive to Cincinnati or St. Louis or Minneapolis, I ain't doing it in an electric vehicle. And then otherwise, I got to sit there and plan some ridiculous charging.
We test drove Rivian. All I could think of was like what happens on 95. On 95, like, am I going to push it to a road, to a rest stop? I mean, it's worrying.
Hey, Phil. The company reports obviously April 23rd, so we'll get a lot more details then in terms of price cuts, what actually meant to underlying cash flows. You were in Chile not that long ago. You mentioned the production out of the Shanghai factory. But give us a sense in terms of your expectations in competition in other markets where the Chinese can come in with vehicles that are still priced far below what Tesla's able to do.
Not only are they priced below what Tesla's able to do in electric vehicles for the most part, because of the advantages that they have in terms of scale, in terms of labor costs in China. But on top of that, David, when you go to a place like Chile, the thing that you notice is that the internal combustion engine vehicles, $4,000, $5,000, $6,000 cheaper from a Chinese automaker compared to a comparable vehicle. We compared one from Great Wall versus a Toyota. They were both mid-size SUVs. No comparison at all. And when we talked with consumers, they all said the same thing. It's pretty good. Why wouldn't I buy it? It's $5,000 cheaper. And that's the competition that not just Tesla, but all automakers are facing. And in terms of EVs, yes, Tesla is king of the hill in the United States and was king of the hill up until the fourth quarter with BYD. Full year numbers, I think BYD probably passes them this year. They're still very formidable, and they've got a lot of advantages. But they are facing a period here where they've got to deal with softness in a number of key markets.
He says that the S&P 500 is getting increasingly vulnerable to a meaningful sell-off. Joining us right now is Sam Stovall. He is Chief Investment Strategist at CFRA Research. Sam, what do you mean? What goes up must come down?
Good morning, Becky. Well, we had a very strong first quarter, actually ranked number 11 going back to World War II. And essentially what we find is that it does offer a running start into April as well as into the second quarter, where we've had an average increase that's better than the average for all years. But what it does imply, though, is of these top 15, 13 of them experienced declines of 5% or more along the way. So an intra-year decline, with the average being minus 11%. And then 8 of those 13 then had a second intra-year decline, which averaged 12.5%. So it could end up being a very volatile year, even though 14 of the 15 then ended with double-digit gains for the entire year.
Oh, my gosh. So buckle your seatbelt. You're in for a potential roller coaster ride.
Exactly.
When did these things take place? Can we put it into any historical context, what was taking place at the time?
Well, you go back to 1975, so right after the 48% bear market triggered by OPEC. 1987 was the only observation in which we had a single-digit advance. 1991, so right after the Gulf War, and then also 1998. These are the top ones that I'm reading off. So that was during the height of the dot-com bubble. So depending on whether we are coming out of a bear market environment, we've been in one, or coming into a stronger bull market kind of an environment, I would tend to say that the real question is, what is likely to be happening based on interest rates, economic growth, et cetera?
Sam, we were just talking gold. You've got some thoughts on why gold is behaving this way, hitting these record highs. What's up?
Well, I think that hitting record highs, first off, because of the prospect of lower interest rates. Certainly, I hate to admit this, but I might be agreeing with Joe in that maybe if we have the possibility that the Fed will be slower to lower interest rates and that we do end up with 2 or even 1 rate cut after the election, then I think that could cause investors, that would be the trigger or a catalyst for a correction. But I think gold has been benefiting from lower interest rates, increased tensions in the Middle East, central banks increasing their purchases. And I also think that we're seeing a slight improvement in the Chinese economy. And that has been propelling gold prices. And I think we could have a target of about $2,600 an ounce.
Okay, I'm with you, Andrew. With Sam's record, if he now agrees with, if he's, yeah, I'm with you. I don't want him agreeing with me.
You're coming to me?
Yeah, I'm coming to you.
Goodness.
With what I've seen from Sam over the years. So you lost me now, Sam.
Sorry, Joe.
That's okay.
The tech trade, big questions about whether it's a tired trade at this point, whether it can continue and AI push that forward. What do you think?
Well, I think that we are going through a digestive phase right now in tech because tech has done so well. Yet still, along with communication services, financials, it's posted a double-digit first-quarter gain. And history says that following up years, you want to let your winners ride. So while we could end up seeing a correction in time, maybe even slight noise, if you will, meaning a sub 5% decline in this area, I would tend to think that tech is likely to be an outperformer when 2024 comes to a close.
You're still looking for 3 rate cuts, though, from the Fed?
Right now, that's what we're looking at, sure, and it's starting in the June timeframe. Obviously, everything is data dependent, even our own forecasts.
Yesterday, the market, I think, kind of bet with its feet and is pushing that off as a less likely scenario.
Yes, but if you look today, we're looking at about a 58% chance that the Fed will actually start in June. So right now, I think it's a toss-up between the first rate cut occurring in June or July.
Canaccord Genuity Chief Market Strategist Tony Dwyer. Tony, good afternoon. So your take overall on what's happening in these markets, and you say to add on a pullback, which suggests maybe don't add now?
Yeah, we have been in that case for a little while now. John, this is kind of an interesting time. It's very rarefied overbought territory. So we use a weekly stochastic for the S&P 500, which is a technical oscillator. For only the 7th time in history, it's above an extreme overbought of 90. I know I'm talking technical here and I'm a macro guy, but it's only the 7th time it's been over 90 for 18 consecutive weeks. It looks like, unless there's a major hit this week, it'll be 19. It's only done that twice before. So it's just an extreme overbought. It doesn't stay there forever. But I also can't find any data that says we should really plunge. Just kind of a pullback to get rid of some of the excesses and to really generate that next leg higher.
Okay, and you also say to expect some further broadening of the market once we work through some of these overbought extremes and progress through the second half. But, when we pull back these days, just the Russell often is getting killed. Like it's down almost 2% today. Does that mean once we do get some real further pullbacks, though, you would emphasize mid caps and small caps?
I do. It's much more of a generational call or a long-term call for us, John, than a trading call. So over the last couple of years, I've done a pretty good job of renting stocks when they get oversold enough and then feeding into it as they rallied, because higher interest rates and weaker earnings distribution has really negatively impacted the average stock or the small cap stock. So what makes for a rental versus an ownership on weakness? And it comes down to 2 things. You have to have interest rates go in your favor. I still believe when the Fed says they're going to cut, I believe they will. If you have a weak employment number, remember the negative revision we had in the last payroll employment report wiped away a lot of that feeling that, wow, they may not even cut at all. So you need lower interest rates, and you also need a broader distribution. I think people would be surprised that last year, if you take out the Mag 7, according to my earnings wizard at LSEG Ibis, TJ Dillon, earnings would have been negative outside of if you take out the Mag 7 growth out of earnings for calendar year 2023. And in this quarter, It's the same thing. You get a broader distribution of earnings as we go into the fourth quarter of this year and into next year. So that's why lower interest rates and a broader distribution of earnings growth and participation is really what drives wanting to own stocks on weakness versus renting stocks on weakness.
But what if the Fed doesn't cut or doesn't cut as much as the dot plot currently suggests? And I asked that on a day where Roger Ferguson, former Fed official, came on CNBC earlier and floated the possibility that that could, in fact, happen. Maybe it's still a minority view. Maybe it's still not a strong likelihood. But he is also seen to be somewhat of a Fed whisperer in his own right, too. So what happens then for the market? What's positioned for that possibility here?
Morgan, I really think we got to, they say they're data dependent. The problem is it's very incomplete data. And I've gone through a couple of times how the survey rate when you get the payroll data is so flawed because it's very incomplete. But ultimately, remember that the Fed only expected in 2022, in the beginning of 2022, there was only going to be 3 rate hikes for the cycle. Mm-hmm. So the Fed can change, they're just as good as me at being wrong. And they will change with the data. And I think that data... Listen, we've had a manufacturing recession for the last 18 months. So having an ISM on an inventory replenishment, that may soften the blow if you have a services slowdown with employment weakness that really, it hasn't happened. I thought it would have happened by now. But if you look at the NFIB hiring plans index at a cycle worst, the ISM employment is bumping along at cycle worst. The Conference Board leading employment index is right around its cycle worst. So where I'll be wrong is if it is a no landing. I don't know how you can do that without gas. But if you do have a no landing and rates don't go down.